To grow a property portfolio, you have to understand the importance of lending, because to try to do it with 100% cash, it's just not going to happen. Today, we're going to be talking with mortgage broker Nick Wilcox to give us the inside scoop of behind the scenes of lending. What do you really need to know about someone who is serious about building their wealth, and the various different lending policies available to us? Nick is going to open up the details to help you get smarter and closer to achieving that goal you know you can. I'm Jeremy Iannuzzelli. This is what school should have taught you. Let's get into today's episode.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Nick, thank you very much for joining us today in this episode. I'm really excited because we're going to have the chance to chat with you about lending and behind the scenes, and you've got a fantastic career and you've been in the banking space for well over a decade now. And I know you help a substantial amount of clients in the commercial property sector, residential property sector, and you're a bit of a go-to person for all the tricky lending, all the people with large and complex structures. And I suppose one of your strengths is you know how to read a financial set of accounts. You know business quite well, and lending, I think, for you is kind of second nature. But Nick, welcome to What School Should Have Taught You. How are you?
Good, thanks. Thanks for having me. That was a nice intro. Thank you.
Mate, we only do the nicest intros here at What School Should Have Taught You. But I really want to get into today because there's a lot of great juicy content and topics that I want to discuss. And you and I, we often chew the fat on a weekly basis. I learned so much from you regarding lending policies and what these 56, 57 different lenders are doing at any one particular time. And I really thought it was a great opportunity to bring you on the show because your knowledge around policy, from what I know, and for the people I speak to, is pretty much second to none. Got a great conceptual idea of how to produce people's numbers in... No, nothing silly, of course, but how to produce people's numbers in a way and how to get them ready for more lending. And you're a solutions man. You're not just a person who says, give me this, I'll get you that. No, you work with your clients to make sure that they're getting the best result they possibly can. And you're not just talking about loans over 20 years. You're talking about, guys, we'll go through this and then we'll move you into that. And that's a way that we can expand your portfolio. But I'm not going to steal the thunder, mate. I'm going to actually get straight into it today. And I just want to say, Nick, for everybody that's out there, because, you know, for most people, we think, yeah, we just go to a broker, we get a loan and move on. But how different is lending actually behind the scenes compared to what we see as a customer or client? Is there more than just us filling out a couple of forms? What happens behind the scenes?
Well, it's case by case and it depends on the client, but you get the person who goes to their bank after 20 years and they get declined and then they get annoyed and they kick and scream and say, oh, my bank, stuff the banks, they don't approve me. I was like, well, you went to the wrong bank. You're this type of client and you're trying to get into this type of bank. It just doesn't work. So the broking space at the moment, I think it's more than 70% or more than 60%. It just keeps increasing of the current lending market. And yeah, it's pretty much, if you don't go to a broker, you may not be getting the best outcome for yourself. And then just in the backgrounds, it's just the niche policies. Like, if we're just sticking to residential right now, there's expat policy, there's commission, overtime allowance, special services, police, medical, physio is considered medical, and nurses, like there's so many different policies. And then if you just walk into your local branch, you won't get the best service. So
now for most of us though, all banks are the same. They're there to lend money to people. Are they all the same, or a certain profession or a certain person is more suited to a different bank? Do you guys have to have that thought process happening, when you're meeting people, or are you shopping that around to various different banks, or you're really knuckling down on policy?
People come to me for solutions. They don't come to me for rates. So I get introductions to clients who want to build portfolios, accountants, buyers agents, or just clients who want to do more than just get a rate. So some brokers, they do first home owners. Some brokers do a dollar for dollar refinance. Hey, can you refinance my loan? I want a better rate. I don't really see that. I see, hey, Nick, I need you to help me get lending. I've got this home here. I've got this property or this portfolio. Can you help me, get equity, buy some more properties, come up with a plan? So it's a lot more solution based. Like which lender is the best for the client, not because of rate, because of they allow equity, they allow LMI waivers, they allow, a bunch of things, a better borrowing capacity, trust lending, 88%, 90%, 95%. Like every customer is like a blank canvas. It's like you start from scratch at every single client. It's not like a cookie cutter. Maybe like in the first homeowner space, if you're dealing with a young couple, 2 pay slips, and they want to get a first home loan. It's pretty cookie cutter, but for the clients I deal with, it's very custom.
So it's all very niche. So you have to actually dial down into the details to then have them with a certain different bank.
Yeah, and then we go through the back door sometimes in terms of lending. We go to business banking, we go to private banking. Some of the departments, they do, I wouldn't say they bend the rules. They sometimes have a more of a common sense approach for complex clients compared to just the standard residential channel where it's a tick and flick, ticking a box type of assessment.
Can everybody go through those backdoor channels, or is it only a certain amount of people or certain professions?
So private banking, depending on the lender, you need to have a certain amount of lending or income, depending on the private bank.
What roughly is that number? Is it 1 mil worth
Some of
of
it's
loans?
like 3 mil. Some of them is moving to 5 mil now.
Yep.
And then there's business banking departments. So like there's business banking teams where they, in the small business space, they would do commercial loans.
You used to work in a very major bank in that very special division. Do you want to share a bit about that?
Yeah. So my background, I worked for St. George Bank in business banking I was there for 6 years. It was a really good breeding ground because there's more small businesses than large corporate businesses. So the guys in corporate banking, they had 10 or 20 clients. They did a lot of transaction banking and a lot of admin style banking where we were dealing with small business clients and it was just lending. So every small business they have a house, or most of them have a house. They then like to invest their business profits or their income into residential property. And then they also buy their business premise or they buy commercial property investments. And then at the time we also did super. So like a lot of brokers you go to, they have a niche. I'm a first homeowner guy. I'm a guarantor guy. I'm a bridging guy. Because of my background, I kind of do everything. And we used to do the hard deals. So like they used to come to us and say, hey, we've got this deal. It's a little bit too complicated for the main channels. Can you give us a hand? So that's kind of my bread and butter.
So all the stuff that people don't want to touch.
Yeah, not like it's dodgy, not like it's like really bad. It's just like a lot of entities, different types of cash distributions, like through entities. All this, it's just a lot of work.
Now, I want to ask you a question because you and I often work with very complicated clients. How important, and this is for, again, many people that are listening, you need to be making sure that you're with the right professional, but how important is it for a broker to actually understand a financial set of accounts and tax return the way that an accountant would? Because that's often some of the things that I will work with brokers on, especially newer people in the industry. They just don't understand how the financial accounts and tax returns are being prepared and what we've done and why we've done it and, the add backs involved. Do you want to give a little bit of background of the importance of a broker knowing the ins and outs of financial accounts and tax returns? Now, this is for more people that are in small or medium businesses, not so much for, maybe mums and dads on salaries and wages, but just want to give a bit of context around the importance of the interpretation of accounts and tax returns, Nick?
Like, it's very important. Like, I'm not an expert, but I've probably done more loans than most brokers my age or who've been in the industry. So I've seen and I've done mainly self-employed loans. So I've seen more probably financial statements than a lot of people. It's very important to match the accounting, like the financials to the lender policy as well. So like some lenders will add back depreciation, some won't, some will take a percentage, some will look at one-offs and you can make commentary, instant write-offs, over the mandatory super funds. There's so many different things. You can look at a set of financials and, we use the word massage the deal. If you're just sending through the financials on every deal, it's a tick and flick, like AI can do it. Like we won't be in a job in the future if it was that easy. So it is pretty important in the complex space when you're dealing with large commercial clients or just even small business clients. It's good to have relationships with people in the bank because bankers turn over. So if you find a good banker and you're kind of on the same page and you can explain to them, they can understand and they can sell your deal or the deal to credit. That's kind of half the battle. Like I could be the best at reading financials, but if I then find a banker who's not that good and that they can't present it to credit, we'll be in trouble. So some of the battles just for brokers is to find good bankers.
So again, for people that are listening, we're talking about behind the scenes of lending. It's not just a broker gets you to fill out paperwork and it gets submitted to the bank. There's often channels and open lines of communication that you directly have access to where you get to talk to, is it credit assessment and also a business development manager for the bank to help get the deal over the line? Is that, am I getting it right?
That's right. So in the residential space, you deal with the BDM, and they put out fires, they help you with policies. So there's always a bit of a curl in every deal. There's like it's very rare to get a vanilla deal, especially like the investing clients I deal with or the people who want to maximize their borrowing. There's always something that we need to ask questions for in the residential space. And then, once you get feedback from that BDM, but it's up to the broker to know all the policies. You don't have to know every single policy, but know kind of which hole it fits into. Then you need to speak to the BDMs. But then in the commercial space, you can deal with the BDM, some lenders, but you find a banker and that banker writes the deal for you. You find like some banks, you have to deal with a local business banker, like in that area where the client's based, or you can deal with a centralized team in head office. So it just really depends. That's why we like doing deals with private banks or business bank departments, because we trust that they'll handle the deal from start to finish.
So you get that really good channel, open line of communication early with them. And then it's almost like you're working as a team, that you've got now the internal bank and also you back in and both on the side of the client to try to get their deal over the line.
Yeah, and it comes in waves. Like I used to have really good bankers. Some of them move on to management, and then you get other banks that say, okay, well, you can't deal with a centralized team now. You have to find a local business banker. For myself, build new relationships with people that are good. It's hard. I'm doing a deal now with clients based in Northern Territory, Perth, a few in Queensland, and with relationships turning over, it's hard to build new relationships with people sometimes.
So again, for people listening, it's not just forms that get filled out and sent to the bank. There is, lots of back and forth between your broker and maybe the internal banker, credit assessment team. So a lot of methods of communication that your broker's doing behind the scenes. Because I often, hear from clients, oh, Jeremy, isn't it just filling out the form and sending it to the bank? Well, no, we've just heard it now that, there's a lot of modes of communication and phone calls and emails, I'm sure, between business bankers and private bankers and internal business development managers, which handle the residential space. So there's quite a bit that goes into it, especially as you're wanting to build, a larger portfolio. It sounds to me like you really need to make sure that you know the policy of the bank that you're going to use. But the challenge is, Nick, and again, this is probably one of the last questions I'll answer you before we move on. Policies change. So is it one of these things that you are constantly doing a lot of professional development on with the banks directly to get a scope of what's happening in the market from a policy perspective? Or is it just policies that stay stagnant and we kind of don't have to worry too much about them? How much time do you spend on policy changes, if there is any that's happening?
So we get regular emails from BDMs, and BDMs call us. Like they're trying to sell to us. We're their people that they're selling to. So they'll call us. We have every Monday, we have a different BDM from a different bank, residential or commercial, come into our office and present to us. And while doing deals with these lenders, you're speaking to them regularly. So then if anything happens within that period of time, like some lenders I've always just got deals with. I've never don't have deals with them. And it could just be the type of clients that I get are more suited to, like this. I think, there's hundreds of lenders, or call it 50 lenders. 5 will do the same, another 5 will do the same, another 5 will do the same. It's not like every lender does totally different things. So it's so hard for a broker to pick every single lender and have them on their panel. So you kind of build relationships with your core kind of panel. You don't want to test someone for the first time and then get burnt. So it's a little bit of a trust thing as well.
I understand. I want to move to some red flags. Now, I want to try to give as much juicy content. Again, anybody that's listening, the whole goal is to improve your position, and have some really good people that work around you to get you into where you want to be, which is ideally more properties or more assets. What are some of the red flags at the moment that the lenders are looking for? What's kind of the thing that stands out that says, nah, this is a deal breaker, not going to happen? Can you share a little bit about that?
Depends on the client and the deal, but like in a space I play in, like commercial, or some high net worth clients, tax debt is a bit of like self-employed clients. Tax debt it's a red flag with some lenders. So major banks, it's just a big no-no. Second tier lenders, or even some other major banks through different channels, don't ask for tax portals, or it's not a requirement. So like in the commercial space, it's mandatory. Any commercial deal you do, tax portals for the entity, like an SPV for the individuals, and if there's a trading business. So if there's tax debt, big red flag. They look at that as, you've got bad behaviors and you've got external liabilities as well, which ATO wants it paid at a more than 10% interest rate over a short period of time. So if you're with a lender and they say, hey, we'll do the deal, but we need to put in that $200,000 into the borrowing capacity, paying it off over 12 months, like it usually blows out. But that's only with the major banks. There's a lot of other banks out there that then niche in that, saying, okay, we'll take on tax debt. So you can do like a little bridging facility with a second tier lender, clear tax debt, and then move to a major bank. bank. That's what I see.
So when you talk about bridging facilities, is that the bank giving you money to pay the tax debt and then you can buy the property? Do you want to just explain that?
I'll call it a bridging facility, but it's just like a temporary lending. So like, say if you've got some commercial debt and you need to pay out some tax debt, but you can't go to a major bank because they won't help you pay out the tax debt, but you don't have the money to pay out the tax debt, you then refinance to a Red Z, Latrobe, Liberty, think tank type of lender, pay out the tax debt, and then once that's all paid out, you can then refinance back to a major bank in the future.
They'll let you extract the equity out, use that to pay down the tax debt, then you can continue on your merry way.
Yeah.
Beautiful. So tax debt's one red flag. What are some other red flags that we need to be wary of so we're getting ourselves in a position to have very strong borrowing capacity?
I wouldn't say red flags, but like things that blow up borrowing capacity is HECS debt, help debt, credit cards, personal loans, car finance, private school fees is big killer, private health. They're kind of the big key. Like if you're a young couple and you're wanting to maximize, live at home with your parents for as long as you can, if you do move out, rent somewhere cheap. Don't go spend $1,500 a week on rent, depending on your income. Don't go get a car finance and have it, with a really high repayment. If you need a car finance, get it, maybe with a balloon or a longer term so the repayments are down.
So Nick, I just want to touch base on, let's say for argument's sake, a credit card. Most people have a credit card, right? Not everybody has tax debts. But if I've got to say a $20,000 credit card, I'm earning 150 grand gross income. What does that 20 grand liability credit card, or what does that 20 grand limit credit card potentially reduce our borrowing capacity by?
So based on some numbers I've run recently, I've done some scenarios. It's about 80K.
80K. So again, for everybody that's listening out there, if you've got a liability with $20,000 on the credit card, you may have just gone away for a holiday and you've spent some money, or you might have a credit card with a facility of $20,000, then you're going to be reducing your borrowing capacity by about $80,000, which could be the difference of you buying a better quality property or not. What are some things that people should do maybe just prior to lending if they may have a credit card with a $20,000 debt or a $20,000 facility, Nick?
The credit cards, it's the limit that the lenders, they go off. So, you could have three $20,000 credit cards at 60K all sitting at zero, and people say, oh no, but I never use them. So it doesn't matter. You can use them tomorrow. You can max out to 60K. So a 20K credit card in that example is pretty high, but if you're a young family and you want to manage your spending on credit cards, maybe get some points. Depends on their income. If it's a high income earning couple, credit cards don't really do too much. But if we base on the average couple wanting to build a portfolio or buy a home, a 20K credit card's a lot. Reduce it to 2, 3, 5. Don't have a credit card. That's really your only option. It's the limit is the killer.
That's a big point for everybody that's listening. If you've got multiple credit cards because you love your points and you want to try to fly first class everywhere you go, not only does the additional spending hurt your borrowing capacity because you're spending lots of money, and the bank doesn't like to see that because they want you to make sure you've got plenty of money left over to pay their debts. But more importantly, you've got all this availability to credit, which, as Nick just said, you can use at any particular time to do anything you want, and that's going to reduce your borrowing capacity. So if you're looking at wanting to get ready for your first or second property, or wanting to buy 3 or 4 or 5 or 6 properties, whatever it's in your goal, make sure that you're having that chat with your broker early on. Get a bit of an understanding of your liabilities, your open limits, so that way the broker can give you the advice that, hey, you've got potentially 1 or 2 credit cards there with a 5 or 10 or 15 grand limit. You're not doing anything with it. Get rid of it or knock it down to 2 or 3 or 4 grand. And that way, at least you're not going to hurt your borrowing capacity too much. Because if you're, as Nick said, not on huge amounts of family income, you're just the normal hardworking battlers, you got to make sure that you can absolutely increase every little thing around you to improve the borrowing capacity to get you into the best property that you possibly can. Nick, I want to ask a quick thing, and these get thrown around all the time. Lease doc, alt doc, low doc, full doc. I just want to get from you a quick 1 or 2 minutes on each of them. So a lease doc loan, give me 2 minutes on what a lease doc loan is.
So a lease doc loan is where the lender so it's for commercial investment only. So there needs to be a lease, and it's for commercial property, typically standard security, shop, or warehouse, office, and childcare. It's kind of how the big boys in town finance. If you go buy a building, you're not showing pay slips in your financials. You're buying it on the merit of the building. So you can go buy a commercial property, say it's a warehouse, say it's $1 million. Lenders lend up to 65%. Some lenders, 70% on other lenders. They look at on an interest cover ratio assessment. So the net income versus the interest expense with a multiplier. So the multiplier could be 1.25. So residential lenders use a buffer. Say it's a 5% rate, 3% buffer, it's an 8% assessment rate. With commercial, say it's a 5% rate times by 1.5, it's kind of at 7.5% rate on an interest-only assessment. So the net income, call it 60K, 6% of $1 million, needs to cover the interest with the multiplier.
So that 1.5 times. So for every dollar of interest, they want to see $1.50 of income. Is that right?
Exactly. At interest only. The lease, there also needs to be a lease. So right now there's a lender, I won't say their name because it's IP technically, but it's a really good lender, major name. They can go up to 70%. They want a 2-year lease. If it's a 6% return, high fives, you can get 70% LVR. Typically, you need to borrow in an entity, company, or trust. The directors and shareholders of that company or trust provide a guarantee. The lender does not look at your external income, liabilities, anything.
So you can borrow money just by putting 30% down as a deposit, making sure that you've got, say, arguably, $1.50 of rental income for every $1 of interest. Yes, you provide a guarantee, but there's no pay slips. They're just purely looking at the tenant, the lease, and looking at the deposit.
So you could be maxed out in residential borrowing capacity. You could have just sold your business and retired. You could be doing it as a joint venture with a friend or family, and it gets a bit complicated to show everyone's income. Like right now, the assessment being with this lender 1.25 times at 70%, it's the same rate, the same fees, the same charge. It's the same in the customer's eyes. It's the same product. There's
and you said the interest rate had a 5 in front of it. Is that right?
I used it as an example. It's a low 6s at the moment.
You got me very excited there. I was like, "Whoa,
five's an easy number to
I was
use.
like, what's going on?" But even with a low 6 from commercial rates is fantastic.
There are some rates at the moment in the high fives, 5.7, 5.8 for fixed, and clients are selecting fixed for this lending. If they've got a lower yielding property, say it's 5% yield, you can't get to 70% because the net income of a 5% yield, just quite right now where the interest rates are, can't get you to the maximum LVR. But if you get a lower interest rate, that then helps your borrowing capacity because it's a lower interest payment versus the net rent. You can borrow more. So some people are taking up a fixed option for 12 or 24 months, just so they could borrow a little bit more and keep that, either buy a better property or keep some cash in the pocket.
And that makes sense, right? Because again, they're looking at the 1.25 times income versus the $1 of interest. So again, for all the listeners out there, a lot of my clients actually do a lot of lease stock lending, and Nick and I share many of those mutual clients that do it. It's a much easier way to get loans. They're not looking at all these pay slips and thousands of different council rates if you've got lots of properties. But it does come with a covenant of a much higher deposit. So you might be a person who has the ability to save for deposits, and again, commercial property, a lot of people buying it for the cash flow that it provides. So it's a great way to continue to borrow, and you're outside of, I believe they call it NCCP. Is that correct, Nick?
Well, technically it's commercial, so there is no NCCP, but what the lenders look at it, they kind of like, they ring tight within the entity. If it's in your personal name, which some lenders do it in your personal name, they will say, well, that's personal income. We need to then look at the group, because it's everything. It's in your individual name. You still can do it, but most lenders, they want it in an entity. So
and that way they exclude all the having to look at your personal income. So again, your structure is important depending on what type of asset you're buying, and then that needs to be matched with the lending. So for a lot of my clients, I'll say, guys, first you need a very strong lending strategy. Then you need to look at the acquisition strategy, so the type of properties you're wanting to buy. And then the accountant should be looking at the tax and structure strategy. So which entity you're going to be looking at and how do we minimize tax. So a lot of people will come to me first and I'll say, guys, I'm actually the person who puts it all together based upon what you decide to do from a lending perspective, an acquisition perspective, and then more importantly, my side of things, which is the tax and structure strategy. Nick, that's brilliant. So again, a lot of people out there, lease stock loans, it's focusing on tenant, it's focusing on lease, it's focusing on the income, interest rate, not necessarily looking at your borrowing capacity personally. You need to make sure you structure it the right way.
Well, with lease stock, just so before you move on, you have to have the equity or cash available. So like I get clients like, I've built this resi portfolio, I've hit a wall. I heard that now I can move to commercial and I can go, buy a commercial property. And it's like, okay, well, how much deposit do you have? I don't have anything. I've got a lot of equity. But I've hit my borrowing capacity. So you need to have you can't cross secure. You need to get the equity either by pulling equity out through lending or if you've hit a wall, you need to have a discussion with your accountant or your advisor and maybe do a sell down. And it's quite common at the moment where a lot of resi investors are selling down their residential properties to get cash to buy lease stock, or to get cash and to improve their borrowing capacity to then get more equity out. So with lease stock, it's pretty much, how much deposit do you have? Everyone wants to buy the biggest and best property. No one comes to me and says, hey, I want a 30% LVR. They come to me and say, I want the biggest and best property. And I say, okay, how much cash do you have? And then we reverse engineer it from there.
Beautiful. And again, anybody listening, we've done a great podcast on exit strategies where, we spoke about potentially residential property not being a great retirement asset. There's pivots that may occur. And this is potentially where an exit strategy comes into play, the movement of residential to commercial. Now, Nick, I haven't really seen a huge amount of these. I did see a lot of these during the post-GFC era, but low doc loans, can you give us a quick wrap up of what a low doc loan is and why maybe you would go down the low doc loan path?
So now there's a lot of different loans: no doc, low doc, old doc. They call them, each lender has a little fancy name for it just so it doesn't sound too bad. But low doc loan, some people think it's like, oh, I'll just get my accountant to write whatever I want on the letter and I'll get a loan. It doesn't work like that. It's not how it works. It's not what it's designed for. As a broker, we need to do our own verification to make sure it's correct by getting different supplementary incomes to verify. So we're comfortable. But a low doc loan, it's for businesses in different periods. So if you've set up a business 2 years ago and your business is like booming right this second, but you don't have tax returns. With a self-employed client, you use historical tax returns, 1 or 2 years. So the last year of tax returns was 2024, which is a year ago it finished. And then a year before that is when it started. So a low doc loan is where a lender's like, okay, well, if you get me a couple buses, get me an accountant's declaration that confirms income, show me some bank statements. There's 3 different options. The accountant declaration is typically the one we use. And the accountant declares, what is the income right now? Like the income right now, it could be, they had a really big ramp up, or it's post-COVID. COVID, they had a shocking year or two. The income on paper is not too good. But right now, the income's thriving and the accountant's happy to declare the current income right now. So yeah, there's different forms, but they're pretty good, to be honest. Right now, all the lenders have reduced their rates for low doc.
What's a typical rate for a low doc loan? Because I remember these used to be 400 to 500 basis points, if not 600-700 basis points. So that's 4 to 7% higher than, the couple of the best rates that are out there. Is it a still relatively high rate, or is it quite competitive?
So major bank owner-occ rate, I don't know, call it high fives right now, mid to high fives, depending on which lender you're at with a P&I rate. It's about 1% more, give or take. Right now I'm looking at with one of the big ones, I'll say Latrobe, okay? They're 6.79, 6.89. Low doc rate, and their full doc rate is exactly the same. They all get warehouse funding, different sourcing of funding. I don't know if now they just put in the same bucket, but if you go to Latrobe right now with 2 payslips and another customer goes with an accountant's letter, same rate.
Wow, very interesting. Now, for anybody listening, for all people listening, I should say, an accountant's letter is not necessarily just given. The accountant still needs to make sure that they are doing all the due diligence to ensure that the numbers that need to be disclosed and declared are correct. So I've had a couple clients in the past, Jeremy, just put the numbers down as this because that's what I need to get over the line. The answer is no. An accountant just won't simply put any number you want down, even if the broker said that's the number we need. We as accountants still need to make sure we maintain professionalism, ethics, morals, and making sure that we're not putting you as a client in risk. So the numbers still need to make sense. The substantiation needs to be there, and the bank can audit those numbers at any particular time. And quite often, I actually get phone calls. I've done a handful of these letters for clients in the past, or very legitimate substantiation being provided. But the bank will give the accountant a call and they will make sure that the numbers that have been presented on the form are correct. They'll run through the numbers directly with the accountant. So you need to, as a client, to make sure that if you're going to go down this path, you've got the substantiation, which means the information to back up the data and the details that the broker is submitting to the banks. It's not just necessarily a quick little form, Nick, that you know this very well. It's not just a quick little form that gets done. There's a lot of verification that the broker, as you said, Nick will go through all the various information to make sure that it's correct, because Nick and I still have a level of duty of care that we need to make sure that we maintain, so the clients don't get themselves into a position where they've borrowed more money than they can actually afford. So there's a lot that goes into low doc loans, and Nick, I think you've answered it really well, but I'm very surprised to see, say someone like Latrobe, which has always been in my eyes over many years, quite high interest rates, but to see them to become quite competitive, especially on a full doc and low doc loan, that's quite interesting. It may speed up the process for many people. Lastly, mate, I just want to ask one final question, and it's more so the tip on everybody's tongue, right? It's easy for me as an accountant to say, you want to borrow more money, go earn more money. But that's not necessarily how it all works. As a broker, you've spoken about people getting rid of credit cards or, lowering tax debts or HEX help debts and all those other things. But what are some other ways people can actually improve their borrowing capacity without necessarily going out there and earning more income? Because they may not have the means to just bump up income very quickly. They may not be a business owner, they may be an employee. There are any other last words you can give someone to say, guys, you have an opportunity to increase your borrowing capacity. These are the easy low-hanging fruits to do.
First of all, it is those few things, the credit card HEX, personal loans, all of that type of stuff. We were talking offline recently about like self-employed clients, like going to the right lenders where they exclude company debts. And that's just more like the client doesn't need to do anything. They just need to go to a broker or go to the right lender. So say, for example, a trucking business, and they've got 30 equipment finance loans. If you go to your typical lender and 30 equipment finance loans for trucks, you put that into a borrowing capacity, it hurts. Like, trucks are paid off over 5 years, repayments are quite high. There are some lenders, some very good lenders, that will exclude all company debt. So like all company debt, and they won't look at depreciation and interest. They just assume that nets out. So, we've done some examples for clients where they could borrow so much more just going to the right lender, and then also going to a broker who might specialize in investment lending or does second-tier lending. So it's something the client doesn't have to do, but the broker can select the right lenders for the customer, and there could be hundreds of thousands of dollars in borrowing capacity, or the right structures for maximizing borrowing. So they need to speak to their accountant. There are things like trust structures that can also help your long-term borrowing, but that's a whole nother topic that we could speak for.
Yeah, and I've done a great podcast on structures. So anybody wanting to know a little bit more about structures and improving finance, there's a podcast on it where we speak about trusts if they're in a position where they're self-sustaining, meaning the entire income of the entity less the entire expenses of the entity. If it produces a profit, some banks will actually exclude the debt of those entities, and allows you to kind of park that to the side and continue the borrowing capacity as you move forward. So a couple things there that you've said. These are, again, low-hanging fruits for all people that are listening to improve your position. It's number one, making sure that you're being matched with the right lender. You heard Nick talk about different lenders will have different policies for different people and professions. There's different tiers of lending, and we spoke about various different style of loans, whether it's a lease doc loan or low doc loan or a full doc loan. But again, tiers of banks. The easy ones we all know about, reducing debts and also reducing expenses. So making sure that you're prepping yourself for more lending, that's important. Dependents. Now, one big thing is if you are looking to start a family, dependents, Nick, they generally will reduce your borrowing capacity. Is that correct?
They do, and you can't hide dependents. So
and you mentioned private school fees and all those things. So it's timing. It's those windows of opportunity. If you know that your kids might be at a public primary school and you're wanting them to go to a private school moving forward, or you're looking to have more children moving forward, that might be a great window of opportunity for you to maybe borrow more money and get a couple more of assets under leverage. So, I always say to my clients, never lie to me and never lie to your parents. But I think I can add now mortgage brokers on that list, because you need to make sure that you're advising your mortgage broker of what you're thinking of doing. If you're wanting to start a family, or your spouse might be pregnant, your kids might be going to private school, you need to really engage with your mortgage broker to share all that level of information, because people like Nick can actually say, guys, if that's the plan over the next couple of years, our window of opportunity, our borrowing capacity is probably in its best state that it can be, because once you start adding private school fees and higher costs, and kids need new shoes, and Nick and I are parents, so we know all the costs associated with having children. They're the things that you need to make sure that you know, that's what you're going to be heading into, because that's when your borrowing capacity might be reduced. And the last thing Nick mentioned to improve your borrowing capacity without necessarily having to earn more income is making sure that you are getting into the right structure. And we spoke and heard about, if we're going to go down lease stock lending, you can't do that if you're in your own name, because they're going to look at all your personal income. Where if you go lease stock lending through a company or a trust with a corporate trustee, that is where they'll literally just look at the lease. I think you said a couple of banks will look at a minimum lease term of a couple of years. They'll look at the ICR commitment, which is your every dollar of interest must achieve this amount of rent. And it does require some deposit, quite a bit, which we heard about 30%. So it's one of those things you need to make sure you're strategizing with your parties around you, your buyer's agent, your property consultant, your financial planner, your mortgage broker. They're the people that are really in charge of helping you leverage up into more assets. And then lastly, your accountant. Nick, I just want to thank you very much for today. You've given a lot of clarity around some things for people that may have not heard of, things like lease stock loans, low doc loans. You've spoken about ways that we can improve our borrowing capacity as well. For anybody that's listening that wants to talk to Nick about their own lending situation, you can reach out to him via their website, bluecranecapital.com. You'll be able to see Nick's face there on the website, and you'll be able to reach out to him directly and chat about your overall lending. Nick, I just want to say one last time, mate, thank you very much for coming on What School Should Have Taught You and giving all of our listeners some really good insight into lending and also the ways to improve your lending in the various different loan structures. Nick, thank you very much.
No, thanks for having me, mate. I think you and me, we could sit here for half the day talking. Like we didn't talk about super funds, development loans, no doc loans, so many different loans. So everything we've said here today is just general. There's no financial advice, disclaimer. But yeah, reach out anyone if you need anything. Happy to help. Just answer any questions. Feel free to reach out.
No worries. And what I might do is I might even throw Nick in a corner and say for all of our listeners, he might just be able to have a chat with you for 15 or 20 minutes. There'll be no cost. At the same time, I think it's definitely another episode, Nick, that I might need to grab you on, and we can go through all the juicy stuff around self-managed super fund lending. I know in my office we're establishing lots of super funds for clients as they're wanting to purchase more and more properties under leverage via their super. But guys, that's what school should have taught you. Thank you, Nick, and I'll be seeing you guys next week.